Well, taking a look at the market action, we've got a couple of days before our earnings kick off into high gear. The U.S. banks start reporting on Friday. Ahead of that, we're in kind of a malaise. But keep in mind, last week we had the S&P put in its worst weekly performance in 3 months, even with that big surge that we saw on Friday. Our next guest says that if we continue to see this sell-off in bonds and the rally in oil, we could reach a breaking point for equities. Lukasz Tomicki is the founder and managing partner of LRT Capital. And Lukasz, certainly that spike in oil prices, as well as the spike in bond yields, did have the S&P wobble. What are you looking for?
Good afternoon, and thanks for having me. As you astutely pointed out, what's been happening over the last 3-4 months has been a steady rise in both long-term interest rates in the United States and oil prices. And I've been trying to coin this phrase called the upside down. And if you remember the upside down from the TV show Stranger Things, it's this world, this alternative reality world where things are reversed. And paradoxically, I think we are kind of in this upside down because equities are being currently seen as safer than bonds for many investors. Because if we're in an environment of somewhat persistent inflation, bonds and their real value gets inflated away and it benefits the equity holders. Now, this upside down that we're in can only last as long as we still believe that the Fed has room to cut interest rates, which is what they've been signaling all along. But if that becomes in doubt or in question, then we can very quickly exit the upside down to a more realistic world. And the 10-year Treasury is signaling that it's gone from a very benign inflation expectation environment to one that's more mixed. And if we head towards 5%, and we can go there very quickly, as we know in these markets, then I think the equity markets around the world will really come under pressure.
I guess let's try and carry your analogy of the upside down where things are not kind of happening as they should. And I'll suggest that maybe things are right side up. Look at the economic data. You know, the Atlanta Fed GDP now gets revised higher. The job growth is significantly higher than expected. We're getting a mixed read of inflation, to your point, but generally it has been cooling down. And at around 3%, if you're, a business in the U.S., you've got growth and 3% inflation. Isn't that generally positive?
Absolutely. So we've gone from a hard landing to a soft landing to a no landing type environment. And that's what people are pricing in. So the environment you described right now, strong GDP growth, strong job market, benign and somewhat declining inflation is fantastic. And especially if you believe we're going to get interest rate cuts later this year. The challenge is that if we get a spike in oil prices, which we can, and oil demand is driven by a very strong economy, and there seems to be some signs of a reacceleration of the economy, particularly in China. And, the SPR, which is the Strategic Petroleum Reserve in the United States, is at half of the level it's been 2 years ago. It's actually the lowest level in over 30 years. So there's not much room to release extra oil to the market. So you can get an easy spike in oil prices should there be more demand than expected. And if the economy continues to be strong and the labor market continues to be tight, inflation can actually surprise to the upside, in which case rate cuts get taken off the table. And so it's one thing to be in a strong macro environment with declining inflation. It's another if we have an acceleration in inflation. Actually, we start talking about not rate cuts, but actually future rate increases. That would be a very different world for the market.
There's a lot of negative, I hear you, that could go wrong. Even in the face of that, the market has just grinded higher. From the last round of all-time highs in 2021, the S&P is up nearly 9%. So it's not just trading sideways, it's adding to those gains. And those gains have happened even as we've pushed out rate cuts. So it hasn't been on the back of this cheerleading. And some might argue that there aren't signs of, excess the way we saw in 2021. How do you account for that? The market's just unrelenting optimism and decisions to kind of persistently push higher, even in the face of some negative news.
Well, because that's exactly what happens in the upside down. Because if there's any economic weakness, you'll imagine the monetary authorities, be the Fed, will start buying assets, cutting rates, not just buying bonds, but corporate, debt as they did in the COVID pandemic. For all I know, in the next economic slowdown, they're going to start buying gift cards for people and just spraying money in the whole economy. At the same time, anytime there's a problem with the macroeconomy, you also see the US Treasury coming to the rescue. If you remember last fall, there were concerns about the interest rates going up on the long end. And Janet Yellen very astutely came out and said she's going to do 60% of the Treasury's financing in short-term bills. And typically they do about 20% in bills. And that put a bit of a cap on long-term interest rates. So I think the perception is that, yes, there's all these risks out there, but if there is any kind of wobble or slowdown or fear, there's plenty of tools the macroeconomy managers, if you will, have to push equity prices higher. So it's basically silly to worry about downside risk, and you should really worry about inflation and protecting your wealth. And to the extent you're able to do that, you do it through the equity markets and holding relatively speculative assets. And that's where you're seeing the most speculative assets, Bitcoins, Trump's Truth Social Network, MicroStrategy, those sort of things benefit the most.
So let's carry your viewpoint forward. You talked a lot about the areas of the market that you're wary about and concerned about. Where do you want to be positioned for when things turn right side up?
So we think when there is going to be some kind of rebalancing to the right side up, as you called it, the money in the market should probably leave the more inflated areas of the marketplace and go to the slightly less loved parts of the market. So for us, that tends to mean commodity markets and in particular energy. And actually, we really like energy stocks.
Have you looked at this sector? It's doing pretty well.
Well, so that's actually the important thing. Energy stocks have been the second best performing sector in the first quarter of this year, despite valuations being very low and actually manager allocations and hedge funds and other places being at record lows. So we've had quite a nice squeeze to the upside in those positions, and valuations are very reasonable. And I believe that if we get a spike in oil prices and a rush out of AI bubble stocks, then we can get a tremendous spike in energy stocks that's really not expected by the market.